Hi guys, welcome to my channel. So before we get started, make sure to hit that like button, also subscribe to my channel. In this video, we will talk about what is a bond? Bonds for beginners. So make sure to watch the full video. What is a bond? When you purchase a stock, you're buying a microscopic stake in the company. It's yours and you get to share in the growth and also in the loss. On the other hand, a bond is a type of loan. When a company needs funds for any number of reasons, they may issue a bond to finance that loan. Much like a home mortgage, they ask for a certain amount of money for a fixed period of time. When that time is up, the company repays the bond in full. During that time, the company pays the investor a set amount of interest, called the coupon, on set dates, often quarterly. There are many types of bonds, including government, corporate, municipal, and mortgage bonds. Government bonds are generally the safest, while some corporate bonds are considered the most risky of the commonly known bond types. For investors, the biggest risks are credit risk and interest rate risk. Since bonds are debts, if the issuer fails to pay back their debt, the bond can default. As a result, the riskier the issuer, the higher the interest rate will be demanded on the bond, and the greater the cost to the borrower. Also, since bonds vary in price opposite interest rates, if rates rise, bond values fall. Credit ratings. Bonds are rated by popular agencies like Standard & Poor's and Moody's. Each agency has slightly different rating scales, but the highest rating is AAA, and the lowest rating is C or D, depending on the agency. The top 4 ratings are considered safe or investment grade, while anything below BBB for S&P and Ba3 for Moody's is considered high yield or junk bonds. Although larger institutions are often permitted to purchase only investment-grade bonds. High yield or junk bonds have a place in an investor's portfolio as well, but may require more sophisticated guidance. Generally, governments have higher credit ratings than companies, and so government debts are less risky and carry lower interest rates. Pricing bonds. Bonds are generally priced at a face value, also called par, of $1,000 per bond. But once the bond hits the open market, the asking price can be priced lower than the face value, called a discount, or higher than the face value, called premium. If a bond is priced at a premium, the investor will receive a lower coupon yield because they paid more for the bond. If it's priced at a discount, the investor will receive a higher coupon yield because they pay less than the face value. Bond prices tend to be less volatile than stocks, and they often respond more to interest rate changes than other market conditions. This is why investors looking for safety and income often prefer bonds over stocks as they get closer to retirement. A bond's duration is its price sensitivity to changes in interest rates. As interest rates rise, bond prices fall, and vice versa. Duration can be calculated on a single bond or for an entire portfolio of bonds. Alternatives to buying bonds directly. If you want the income earning power of a bond, but you don't have the funds or don't want to own individual bonds, consider a bond ETF or bond mutual funds. These are well-diversified funds that give you exposure to many different bonds and pay a monthly or quarterly dividend. Because some bonds have a minimum purchase amount, smaller investors may find these products more appropriate for their smaller amount of capital, while remaining properly diversified. 4 basic things to know about bonds. 1 is strengthen your portfolio's risk-return profile. Adding bonds can create a more balanced portfolio by adding diversification and calming volatility. But the bond market may seem unfamiliar even to the most experienced investors. Many investors make only passing ventures into bonds because they are confused by the apparent complexity of the market and the terminology. In reality, bonds are very simple debt instruments. So, how do you get into this part of the market? Get your start in bond investing by learning these basic bond market terms. 1. Basic bond characteristics. A bond is simply a loan taken out by a company. Instead of going to a bank, the company gets the money from investors who buy its bonds. In exchange for the capital, the company pays an interest coupon, which is the annual interest rate, paid on a bond expressed as a percentage of the face value. The company pays the interest at predetermined intervals, usually annually or semi-annually, and returns the principal on the maturity date, ending the loan. Unlike stocks, bonds can vary significantly based on the terms of its indenture, a legal document outlining the characteristics of the bond. Because each bond issue is different, it is important to understand the precise terms before investing. In particular, there are 6 important features to look for when considering a bond. Maturity. This is the date when the principal or par amount of the bond is paid to investors and the company's bond obligation ends. Therefore, it defines the lifetime of the bond. A bond's maturity is one of the primary considerations an investor weighs against their investment goals and horizon. Maturity is often classified in 3 ways. Short-term, bonds that fall into this category tend to mature within 1 to 3 years. Medium-term, maturity dates for these types of bonds are normally over 10 years. Long-term, these bonds generally mature over longer periods of time. Secure or unsecured. A bond can be secured or unsecured. A secured bond pledges specific assets to bondholders if the company cannot repay the obligation. This asset is also called collateral on the loan. So if the bond issuer defaults, the asset is then transferred to the investor. A mortgage-backed security, MBS, is one type of secured bond backed by titles to the homes of the borrowers. Unsecured bonds, on the other hand, are not backed by any collateral. That means the interest and principal are only guaranteed by the issuing company. Also called debentures, these bonds return little of your investment if the company fails. As such, they are much riskier than secured bonds. 2. Risks of bonds. Bonds are a great way to earn income because they tend to be relatively safe investments. But just like any other investment, they do come with certain risks. Here are some of the most common risks with these investments. Interest rate risk. Interest rates share an inverse relationship with bonds. So, when rates rise, bonds tend to fall and vice versa. Interest rate risk comes when rates change significantly from what the investor expected. If interest rates decline significantly, the investor faces the possibility of prepayment. If interest rates rise, the investor will be stuck with an instrument yielding below market rates. The greater the time to maturity, the greater the interest rate risk an investor bears, because it is harder to predict market developments farther out into the future. Credit or default risk. Credit or default risk is the risk that interest and principal payments due on the obligation will not be made as required. When an investor buys a bond, they expect that the issuer will make good on the interest and principal payments, just like any other creditor. When an investor looks into corporate bonds, they should weigh out the possibility that the company may default on the debt. Safety usually means the company has greater operating income and cash flow compared to its debt. If the inverse is true and the debt outweighs available cash, the investor may want to stay away. Prepayment risk. Prepayment risk is the risk that a given bond issue will be paid off earlier than expected, normally through a call provision. This can be bad news for investors because the company only has an incentive to repay the obligation early when interest rates have declined substantially. Instead of continuing to hold a high-interest investment, investors are left to reinvest funds in a lower interest rate environment. 3. Bond yields. Bond yields are all measures of return. Yield to maturity is the measurement most often used, but it is important to understand several other yield measurements that are used in certain situations. Yield to maturity, ITM. As noted above, yield to maturity, ITM, is the most commonly cited yield measurement. It measures what the return on a bond is if it is held to maturity and all coupons are reinvested at the YTM rate. Because it is unlikely that coupons will be reinvested at the same rate, an investor's actual return will differ slightly. Calculating YTM by hand is a lengthy procedure, so it is best to use Excel's rate or yield map functions, starting with Excel 2007. A simple function is also available on a financial calculator, current yield. The current yield can be used to compare the interest income provided by a bond to the dividend income provided by a stock. This is calculated by dividing the bond's annual coupon by the bond's current price. Keep in mind, this yield incorporates only the income portion of the return. ignoring possible capital gains or losses. As such, this yield is most useful for investors concerned with current income only. 4. Nominal yield. The nominal yield on a bond is simply the percentage of interest to be paid on the bond periodically. It is calculated by dividing the annual coupon payment by the par or face value of the bond. It is important to note that the nominal yield does not estimate return accurately unless the current bond price is the same as its par value. Therefore, nominal yield is used only for calculating other measures of return. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.